We're having a slowdown, an economic slowdown. Yes, a lot of you watching will be too young. You've never seen a recession. It's brilliant. Bin bags piling up in the streets, the spectacle of lunchtime suicides in the city, and Sean John changing his name to Alan to avoid paying tax. We're not in a recession yet. A recession requires national output to show negative growth for 2 consecutive quarters. But we're getting there. So, between the tiers, you need to know what everyone's talking about. Here's my glossary of terms. It's quite similar to the one published in the Times the other day. Funny that.
Bear.
No. Not the sort you see in Kemp Town on a night out. Describing someone as bearish means they have a cautious and conservative outlook. They're more inclined to be pessimistic. A bear market is characterized by falling share prices and poor returns. Bear times are bad times.
Bear squeeze.
Not a Sunday morning in Kemp Town, darlings, but a slight rise in share prices after they've fallen sharply, as traders who've been short selling buy back or cancel their bets.
Bull market.
Share prices are consistently rising. Think bull in a china shop. Excited, but potentially dangerous, like Michael Barrymore at a swimming gala.
Bear market.
Share prices are consistently falling. Think bear with a sore head, like a guest at one of Michael Barrymore's swimming galas.
Dead cat bounce.
This is when a share rallies after a large fall before it drops again to new lows. It's so called as it's just like a cat that falls from a height and bounces on the ground, even though it's dead. Go on, try it.
Catching a falling knife.
This is when real risk takers buy up shares as the prices fall, hoping they may soon rebound. It's likely to have the same effect on your wallet as actually catching a falling knife will do on your hand.
Correction.
A misleading term, this. It sounds minor, but it actually means quite a steep fall in the price of shares. So a correction is the opposite of an erection.
Credit crunch.
I can't eat more than 2 myself. The money markets freeze as people default on their loan payments. Big banks refuse to lend each other money, and while some banks hoard their cash, others are left exposed without enough cash in their pockets. Hence Northern Rec. That sold too many mortgages to people who couldn't pay it back.
Going long.
I hear that this is a good night out with Liam Neeson, but in this case, buying shares in the belief that eventually the price will increase, producing a profit. It's like never taking your toys out the box in the hope that antique conker David Dickinson will one day give you a big wad of cash for them.
Growth recession.
Yeah, I once took a couple of Chinese tablets off the internet to cure that. Not really. It's very slow economic growth, which can have a similar effect on consumers as a recession.
Hedging.
No. Clear your mind out. It's nothing to do with that. Hedging is taking 2 positions that will offset each other, like betting on the red and black in roulette. You or I would lose half our money, but hedge fund managers are cannier than that.
Short selling.
This is when traders sell shares they don't yet own, as they believe prices will fall and they can buy them back at a lower price. Say you sold an old iPod for 30 quid. Then on your way round to drop it off, you buy one for 20 and trouser the £10 profit.
Stagflation.
No, this isn't only my avatar name in Second Life, but the meeting of stagnation and inflation. A period of slow growth with high inflation.
Subprime mortgages.
These are home loans granted to people with troubled credit histories. Anyone who's had some documented money worries is subprime.
Wind up.
This is when a company ceases activity with a view to shutting down. Interestingly, too many wind-ups will put the wind up the high street. Well, that's your lot. So now you know. Good luck out there, and remember, don't have nightmares.